All right, welcome back to another episode of the Investing with TJ show. Powell is just stalling for time. Gold and silver look attractive as inflation spiral starts. Now, I want to get into this article very soon because there's some pretty interesting things in here that I think you guys might find compelling. Now, please hit that subscribe button down below before we get started if you are new to this channel. Also, please hit the like button to help get this content out to more people because people are running for the hills right now on precious metals, and we gotta let them know that, hey, when it's time to be fearful, others say, hey, or Warren Buffett has said things, hey, that's the time to be greedy. When people are greedy, that's the time to be fearful. So let's see exactly what is going on in the markets. Physical gold and silver will continue to be attractive assets as investors look to protect their wealth and purchasing power as one precious metals firm sees signs of an inflation spiral. Now, that's something that I think we need to keep in consideration. Many people are talking about, stagnating growth, but at the end of the day, inflation is still an issue. A lot of people have actually not been talking about inflation a lot recently. Because of everything happening with Omicron and the potential for lower growth. But on the other hand, there's going to be inflation. So again, I think stagflationary pressures are here. Let's continue. In his latest market report, chief economist of Degussa said not only are consumer prices at multi-decade highs around the world, but growing economic data points to elevated inflation pressures for years to come. And he might also be pointing to the 10-year break even and the 5-year break even, which are definitely at elevated levels. Let's continue. One sector, Polite, said he is watching that highlights the growing inflationary trend is the housing market. This year, U.S. home prices are up nearly 20%. Over in Europe, German home prices are up more than 13%. Now, I will say I've also been tracking the home price housing market as well. I don't talk about it much on this channel, but I actually have some forecasting models on that as well. We should actually expect to see a bit of a dip sometime in 2022, in my view, for home prices. We had a nice run up, but we're starting to see the top really come into play. This is where OER comes in. And then I've talked about OER quite a bit on this channel, and we should expect to see rent prices actually increase while home prices actually may begin to moderate a bit. And with the increase of rent, that again spells, support for inflation or the rate of change of inflation. So in that case, I agree with OER rising, that will be a boon for inflation. Let's continue. Polite said that rising home prices are good indications that sustained inflation across the board is rearing its ugly head. He added that the threat now is that inflation spirals out of control. If people expect goods price inflation to rise and remain high in the future, they will adjust their wage, rental, and credit agreements. For instance, employees will demand higher wages, which is what we're seeing currently with the Great Resignation. Property owners will ask for more money for the right to occupy their home, which again, as I mentioned about OER, that is going to be that's going to give some inflationary pressures there. And lenders will increase their lending rates. So let's keep it going down here. Polite noted that so far, central bankers worldwide have been able to talk down the rising inflation threat. Earlier this week, Federal Reserve Chair Jerome Powell said in testimony before Congress that the central bank will be discussing speeding up the process to reduce the amount of bonds they purchase every month. He also said it is time to retire the word transitory. While Powell is striking a more hawkish tone on monetary policy, Polite said that he is still maintaining dovish policies. Clearly, there is no desire to change the course immediately. What seems to be intended is that people expect the Fed to do something about the inflation at some point in the more or less far future, and that this will suffice to keep them sitting still. So essentially a bit of forward guidance here. A lot of talk to kind of maintain certain behavior within the markets. So far, it seems to be working as central banks are getting away with it. And while the money supply continues to expand at elevated rates, good and In one of my episodes yesterday, I noted that the average rate of money supply growth actually overshot, or I shouldn't say the average rate, but the most recent number that came in actually overshot the average rate of growth for money supply that we've been seeing. So he's right. We are still seeing elevated rates of money supply growth. Goods price inflation will likely remain high in the years to come, and people will probably get used to it as they become used to extremely low interest rates. And as I've said before, time and time again, people confuse rate of change of inflation with price levels. Price levels will not drop. It's the reason why we see movie tickets that are, $10, $15, whereas, 20 years ago, they were like, what, $8, maybe $5 here in the US. And they have not gone back down. But the rate of change of inflation may oscillate, but the price level will still remain elevated. So let's continue. Polite said that central banks have no desire to stop growing inflation threat. The higher inflation has become, the higher the inflation expectations have risen, the more restrictive monetary policy must be. Unfortunately, central banks shy away from abandoning their inflationary policy course, fearing that stepping on the brakes would plunge economies into recession and crash financial markets, which again is one of the things that people have been noting as far as how high the central bank can actually raise rates before that does happen. Let's continue. The growing risk as central banks stall for time is that consumers get punished. He added that inflation would ultimately create winners and losers in the global economy, which is true. Those who own assets will win. Those who don't own assets will buy the products that those who own assets produce. And those products will have higher costs because of higher input costs. So those who don't own assets will lose, unfortunately. Oh, and funny enough, he says owners of assets, which increase in price, benefit while the holders of money suffer. They can buy fewer assets for their money, he said. Polite said investors need to start looking at holding some physical gold and silver in their portfolios to protect themselves. For long-term oriented investors, holding physical gold and silver as part of their liquid portfolio should be particularly worthwhile, as in the coming years, especially when purchased at current prices, which we consider to be relatively cheap, appearing to promise a substantial upwards potential, they can be expected to be both risk reducing and return enhancing. So let me know what you guys think about all this in the comments section below. I think, he brought up some really valid points, things that I've been saying time and time again on this channel. Let me know what you think in the comment section below. Please hit that like button. Please subscribe if you're new. It's been Investing with TJ.